Welcome to the Tony Steuer podcast, presented by Paperwork. Be prepared for life.
Welcome. I'm pleased to be joined today by Barry Flagg, Michael Brohawn, and Bill Comfort. Barry Flagg is the inventor and founder of Veralytic. Barry is a recognized expert in applying prudent investor principles to life insurance product selection and portfolio management, and serves as a sub-advisor to thousands of life insurance trusts. Michael Browhawn is the founder of Your Life Insurance Solutions. Michael is a pioneer in the trust-owned life insurance field. Michael, along with two partners, founded the first full-service trust-owned life insurance totally outsourced firm in the country. Michael is also the author of the Wealth Advisor's Guide to Life Insurance. Bill Comfort is an independent long-term care specialist agent with Comfort Long-Term Care. Bill hosts a broadcast and podcast show, Aging America Radio, with a focus on a wide range of topics, including successful aging. We'll see if life insurance policies successfully age as well. So Bill, Barry, and Michael, welcome to Get Ready. Thank you for joining me today.
Thanks, Tony.
Good to be here, Tony.
It's great to have you guys. So let's plunge on in. The first thing I always like to start out with is if you can tell us a little bit about what are your origin stories? How did you get started in life insurance? Barry, you want to lead off?
Sure. So I started my financial services career in a fiduciary environment, what's kind of described now as a client's best interest environment, where I was an analyst in a financial planning firm for their pension investment advisory business. So that's a lot of words to say that the partners in the firm would come back with pension and profit sharing plan statements. I'd look the funds up in Morningstar, give them a summary. They'd go back to the client and say, here are your good funds, here are your funds that have high costs, and they would make some changes. All pursuant to what is required under pension and profit sharing laws. You fast forward a couple of years, I went to go work in a life insurance agency, again as an analyst. I was told that the way you do decision support for life insurance is you run one sales proposal that's never going to come true and you compare it to another sales proposal that's never going to come true, and that's due diligence, and that never made any sense to me. So having seen firsthand the utility of Morningstar in the investment business and looking around and seeing nothing like it in the insurance business, I applied for the first of our patents in late 90s, was awarded the first of our patents in 2002, and started a business that provides financial advisors with the same kind of decision support, mostly fiduciary financial advisors with the same kind of decision support that I had as a 19-year-old kid in this pension investment advisory practice.
Fantastic. Michael, how did you get started? What's your origin story?
My origin story is I graduated from the University of Maryland with a degree in horticulture. I was a landscape contractor for many years, and when I was around 30, my back was going out. I happened to do a job for a big insurance producer who, when I met with him, was laying on the ground because his back was also going out. And long story short, he brought me into the business, and I worked in a high net worth field for a number of years. And as you mentioned, I really have focused the last 15 years on working in the trust-owned life insurance world, kind of on the other side of the table, purely managing. So while I was in that space, it was really about developing a prudent process for trustees. So now that I have left that company, I now take those processes and I work with wealth advisors who have clients who want to buy life insurance or manage life insurance or sell life insurance. So they always say you're going to have a couple of careers in life, and so I am exhibit one of that. Although I still do a lot of landscaping on the side.
There you go. Bill, how about you? What's your origin story?
Yeah, I'm proudly celebrating my 30th year in the insurance business this year. It wasn't my first career. I have a journalism degree and worked as a radio and TV reporter, anchor, producer, director for a number of years. But I like to say I kind of came to the insurance business naturally, being a third generation insurance man in the family. My dad recruited me to the business when I was 29 years old, and I just had my first kid, looking for something else to do where I could really grow, and it obviously stuck. The first 10 years of my career, I worked in a multidisciplinary independent insurance practice. We did a lot of employee benefits, which I discovered I hated. I very quickly became the disability specialist and had a senior partner who was very wise. In like 92, 93, he handed me about a 4-inch stack of specimen policies and brochures. And he said, my clients are asking about this long-term care stuff. It's basically disability insurance. Why don't you study this and, tell me what we ought to sell and we'll split the business. And in 2000, I made a decision professionally to specialize just in long-term care insurance. I do a little disability. They're two sides of a coin, working years and retirement disability, if you like. So for the last 20 years, long-term care has been my specialty. And like everything else everybody on this panel does, at the end of the day, and I was blessed to be raised with a perspective that you always think about what's best for the client. So I try to bring that to my practice and conversations like this.
Fantastic. Well, thank you all for joining me today. And I think, Bill, one of the things we talked about that's important for people in the audience is that there are the crossover policies that are both long-term care insurance and life insurance is a growing area of the market. So we're going to see more of the conversations and a need to get long-term care insurance into the same conversation as we've had on the life insurance side, that the industries are merging to some degree. So as we get into it, the first thing that brought us together that started this podcast is, why do you feel that life insurance policies are hard to manage? Why is a life insurance policy hard to manage?
Well, I'm going to jump in and go first. And I'm going to say there's two reasons, neglect and knowledge. And the reality is, and I may be, I may be an outlier here, but I don't really think life insurance is that hard to manage. I have found that what happens is that either the people who are managing it have no concept of the product itself, or they neglect it. Those are the two things that I have found. Now, life insurance has become more sophisticated. It's harder to understand. I do believe that. But the reality is that most times I have found that people who have the job of managing life insurance, those are the two issues. They're unaware of the policy, and they don't put the time and effort into the policy, which in reality, if you're a fiduciary, if you don't understand it, then you need to get somebody that does. But that's been the two issues that I've seen, Tony. I don't know about you, Barry or Bill.
Yeah, I would echo Michael's comments and add that I think there's good reason why people have not had really, as a practical matter, the ability to understand life insurance. Years ago, when my father first got into the life insurance business, life insurance was a rate book. Everything was fixed. It was much more regulated when it was all, and there really wasn't much to understand. With the advent of universal life in the 80s, it, to Michael's point, started becoming more complex, and has become more complex since. But all along that evolution, there's been no way. There had been, and this was kind of one of my epiphanies for starting this company, there was no way to measure what was being charged inside the policy, and no way to measure what was actually likely for the policy to earn in performance. And if you don't know what you're being charged, or if you can't measure what you're being charged, if you can't measure what you're getting in performance, there's no way to manage. You can't manage anything you don't measure. You can't manage your employees if you don't measure their performance. You have to measure everything you're going to manage. So when Michael says, it's not all that difficult to manage, he uses Veralytic. So that's coming from somebody who has a ruler. For the people who don't have a ruler, it's hard to manage because you can't manage anything you don't measure.
Fantastic.
I want to kind of add sort of put myself in the consumer's shoes. So Michael and Barry, you all are fiduciaries. You've worked to support fiduciaries who have a responsibility to understand these things on behalf of their clients. But I think the other side of the coin is clients, consumers, policyholders need to know that they shouldn't remain ignorant. Now, they can't be specialists, but too often consumers buy life insurance and put it on the shelf. And it's only when something starts going sideways or they get that letter that the policy's going to fail in a year without a whole lot of extra money or a rate increase or whatever. I think consumers need to know that they can ask, and they should, maybe not every year. I'm just speaking generally, but every 2 or 3 years, you ought to be asking for updates, asking for that data, Barry, that is so important to what you're saying to know what you're doing. And I think that's important as well, that consumers need to be given permission to seek the information.
You're absolutely right.
I would
even, absolutely right. Go ahead.
I would say it's beyond permission. I mean, what Tony and I have talked about this on previous podcasts. Consumers, if they want to protect themselves, they have to. It's not permission to ask. They have to ask for what's actually being charged inside the policy. What are they actually getting in performance? And then ask their financial advisor to help them measure those things to make sure that they're getting the costs are reasonable and the performance is reasonable to expect. I think the biggest mistake consumers make is for permanent life insurance, for cash value life insurance, and this goes back to the days when my dad was in the business, that the premium is the cost. The premium is not the cost. The cost is what the insurance company takes out of your premium. Currently, there's a knucklehead rule that says that insurance companies can quote a low premium while they're charging high costs without disclosing the risk of the insurance company come back and asking for more premium later. You cannot use the premium as your proxy for costs. You have to ask for the cost from the insurance company, and some of them are reticent to give it. You have to ask for the cost. You have to ask for the performance expectations, and you need to find a financial advisor who will be able to measure those things.
And Bill, you're exactly right, Bill. And I was a little bit flippant in my original response that it's, knowledge. But the reality is that what Barry's talking about is absolutely true. And what I have found, a number of years ago, when the cost of insurance increases were really hitting the marketplace, I was doing a blog for the company I left. And so if you Google cost of insurance increase, one of those blogs came up. So I got a lot of phone calls around the country from 85-year-old widows that had no idea. I've got $1 million policy with $100,000 of cash, and I've got it. And so one of the biggest problems is that consumers don't have any concept of these products. And I can remember my mom, who passed away many years ago, had an annuity and got a notice that the surrender charges were up on the annuity. She called me thinking that all the value of the annuity was gone. My mother was not a stupid person, but that's just the consumers don't understand these products. So it's great to say, they should be able to get better access, and that's absolutely true. And I think we'll talk about later about, one of the things that's going to be happening going forward is more tracking of policies as almost a business model, because the biggest problem that I see out there is that consumers they have no concept of this product, how it works, where they could call up Barry or Bill or myself and get something answered, because we're dealing with this on a daily basis. Just like they might be an electrical engineer and I don't know how to wire my house. And that's a big issue, because there are so many people, for example, with the COI increases, who just said, I don't understand, and surrendered their policies. when maybe they shouldn't have surrendered their policies at all, but they just had no concept of how to deal with it. And that was one of the things that was very sad when I was writing a lot about that, the phone calls that I would get and the people that were just giving up their policies and throwing them away. And it's a sad thing.
Definitely.
Tony, for your listeners, one quick plug for you, for your listeners, your articles in Forbes are excellent educational tools. They really provide an understanding of what's going on with the policy in a way that I think consumers can understand. So any of your listeners who want to also follow Forbes or follow you on LinkedIn, I would encourage them to do so. Too much writing about life insurance is why whole life is the best, why indexed universal life is the best, why universal life is the best, and that is not coming from the consumer consumer or financial literacy perspective that you come from. So I encourage anybody to follow Tony or Forbes, his writings on Forbes, for better education.
Great point.
Well, thanks, Barry. I really appreciate that. And for listeners out there also, that's why I created questions and answers on life insurance. This take away from all the other books out there is life insurance is not a bank. Life insurance is not an investment at its core. It's an insurance policy that happens to have an investment component. And that gets back to what you're talking about, Barry, is that there is a cost affiliated with using insurance as an investment. So let's get into this. Is perhaps one of you could quickly define what an in-force illustration is, and then the three of you could talk about, are in-force illustrations useful tools and how they can be used?
That's up your alley, Barry.
So since my first experience in the insurance business was, you run this illustration that's never going to come true, and you compare it to something else. I'll kick this off. So, back to the day when my dad was in the insurance business, you had a rate book, you calculated the premium, and that was the premium. With the advent of universal life, the premium is flexible. It's the very nature of the product is a flexible premium product, and so you have a computer that can calculate premiums. So in this change from a fixed premium to a flexible premium, the insurance industry, the National Association of Insurance Commissioners, came up with this regulation called the Illustrations Model Regulation. The goal of it was to make universal life illustrations similar enough to whole life illustrations or other illustrations so that the consumer could look at the premium and the premium would be a proxy for the cost. That is it's well intended, but it is something that in my experience has never worked. So illustrations, again, their use as a due diligence tool or a decision support tool, while that wasn't the intention of this reg, it has never worked. They are nonetheless very useful for cash flow planning, for what if analysis, for financial and estate planning, because if you're going to do an estate plan, you got to know, what the inputs and the outputs are. So they're very useful for planning. They are useless for decision support for product recommendations.
Yeah, and so illustrations in general, I think the biggest rap on illustrations today would be that they are used too often as a marketing tool. And the worst that I've seen that have come across my desk in the last 6 months were index universal life, where you're borrowing money and then you're using it for retirement income, and it's over a 60-year period based on assumptions that may or may not come true. And it's like, well, what could go wrong here? I mean, the biggest problem with an illustration is it assumes a level rate of return, which we know is not going to happen. So I always tell people that I use a life insurance illustration as a guide. But the one thing about life insurance illustration, especially a universal life policy, where you can go out and get the expense pages, I used to tell my clients, it's an Excel sheet. It literally is an Excel sheet. And you can actually take the PDF that the carrier sends you of the expense pages, and you can convert that to an Excel sheet. I don't know if they like hearing that, but that's what you can do. And you can literally then figure out what the cost is per $1,000 of coverage for that year. And that's a very interesting thing to do. I mean, I think, Barry, you would attest to this. The best parts of a life insurance illustration are the expense pages, where you can show the client, look, this is what you're paying for cost of insurance. This is what you're paying for this. This is what you're paying for that. And it's there. And yes, carriers can cook illustrations to make them look better. But when you get those expense pages, that's what it is. I mean, and it could go up, or the rate of return, might not be what they expect it to be. So your cost of insurance could go up because the net amount of risk goes up, et cetera. But the reality is there is some value there for an illustration. The bad thing is that when we use it for marketing, as Barry says, you take one policy and you put it next to another policy illustration. And the reality is that the top carriers selling products kind of have policy illustrations that you could kind of tear apart and say, this isn't going to happen. This isn't going to happen. But that's what sells. And that's the problem with the industry today. And that's why people like Barry, who can tear things apart and have Veralytic, I mean, that's a resource for advisors today to take a look at what's really going on inside these policies.
Fantastic. So, Bill.
Well, my perspective on that is, it's not just the rate of return or the interest rate or whatever. People say, well, it says 6% or 6.5% or 8% or whatever that percent is. And even if you just take the projection, your cash value is not earning that. Again, that was something that I had to learn. I had clients ask me the question, and it's because there's another moving part. And that's the cost of insurance. Barry, as you said, your premium's not the cost. It's what they take out of your premium or the accumulated cash value over time. And just reflecting back into the 90s, because I got in the business in 91, and I watched the older partners in the practice that I joined having to manage some early universal life policies blowing up when interest rates fell through the floor in the early 90s. But the takeaway that I had from that, it wasn't the drop in interest rates. It was the increase in the insurance charges, right? We can model, I can put in different interest rates in an Excel spreadsheet. I don't know what kind of insurance charges to put in. I mean, I'm kind of asking you guys the question, isn't that the biggest, maybe not the biggest, but that's the hidden issue?
I think it's both, biggest and hidden. Morningstar publishes a study every year that concludes that costs are the most, the greatest determinant of long-term performance is costs. High costs adversely affect long-term performance. Low costs add to long-term performance. The costs inside life insurance are a multiple of the cost inside mutual funds. Mutual or life insurance products are not immune to the forces of modern portfolio theory and investment. I mean, costs are both hidden and the most significant determinant of long-term performance.
And what you're speaking to, Bill, there is that, what most people don't understand is in the universal life chassis product, well, any product, your cost of insurance is not based on the death benefit. If you have $1 million death benefit and $300,000 of cash value, you're being charged on $700,000. So the double-edged sword is that when you have a policy where you projected an 8% return and you got a 6% return, now as your cash value drops, your cost of insurance is going up. And it's a cycle. And that goes back to why I wanted people to understand it's an Excel spreadsheet, because you can sit down and one of the, when I first got into business, one of the big issues that the old timers talked about, Barry, you talk about the rate books and everything. They say the biggest problem with life insurance was computers. You can sit down at a computer and you can make something look good, or you can play with that premium to get it to go to age 120, or if you drop it $1, it crashes at 92. I mean, you could literally play with this kind of stuff like that. And so people have to understand that, in the Excel sheet analogy, those two issues, those two variables of rate of return and how it affects that cost of insurance. And when you are looking at taking the policy out, what is that rate of return, and what is the expectation for that rate of return going forward? The one thing I can say that's good now is that, knock on wood, we're in a rate of return for fixed products that can't go much lower, right? I mean, we keep saying that, and they seem to at least stick or go even lower. But, coming out of what you were talking about, Bill, where rates are really high and dropping, hopefully we're going to see some sort of uptick over the next 10 years. It'll take a little bit of pressure off. But boy, it's been bad especially for the last 10 years. The interest rates.
It's interesting. I just did it.
Guarantees.
I just had a client ask me to review his life policy. He still wanted and needed the life insurance, but we were looking at long-term care planning. And would we maybe use the cash value and transfer it into a life policy? What was maybe available in the life policy? Should he buy another one? And one of the things that jumped out at me was he was at the guaranteed minimum interest rate. And he got a current in-force illustration, and it was 4%.
Yeah.
Now, when he bought it in 96 or something, it was like, oh my gosh, I hope it never goes to 4%. And we laughed. He and I laughed together and said, it's at the minimum, but thank God it's 4% and not 0.5%.
Right.
So, there's some interesting things that have changed in the last 12 years, particularly, as you said.
It was another world, yeah. Another world.
So as we move forward, one of the things we talked about earlier is there's a greater trend for insurance companies to be offering the hybrid life insurance, long-term care insurance policies. As those grow, how are those going to impact in-force illustrations and the policy analysis? What trends are you guys seeing with that, or how are you looking at that for the future?
Well, let me maybe, Barry, tee you up, because there's some questions about analysis I don't think I've considered yet. But there's there are all kinds of terms: hybrid, linked benefit, combo, and there's no standardization. So consumers need to know, if you're being told, hey, buy this wonderful combination of life and long-term care, or it's hybrid or it's asset-based, there's 4 or 5 different models. Some of them are 100% guaranteed, benefits and premium. Some, and in fact, the ones that are really exploding in offerings are these chronic illness riders, look, act, feel definitionally like long-term care insurance, but they're built on non-guaranteed universal life or non-guaranteed premium chassis, and even the benefit itself for long-term or chronic illness is not knowable up front. It's a back end. They say, oh, it's a free rider, we're not charging you for it up front. Well, if you're expecting to accelerate your $400,000 death benefit and you need care at 75, you might only get to accelerate half or less. So now, here's what I don't know. What I don't know, I can see from a contract these problematic, unknown, non-guaranteed elements. What I don't know is, will a company drive up the universal cost of insurance if they're having to accelerate more than they expected when they tagged on these living benefits riders up front? And I think that's a critical question to be kind of asking ourselves in the industry. But clients, if you want to know what your benefit's going to be, you got to buy something that's guaranteed, and it's hard to smoke it out today.
Yeah, I would agree. Michael said earlier that people don't understand the life insurance product, and then you add an additional layer of complexity. So I've been in the insurance business since I was arguably 19 years old. You actually could say I've been in the financial services business since I was at the age of like 7, when my dad was helping me read the Wall Street Journal in the back of a bus on a church retreat, right? But long-term care and chronic illness, the disparity in the benefits is enormous. It is not, it is not one size fits all. I think the life insurance, in the same way that clients have a better chance of understanding their investment portfolio because they can get a Morningstar report and they can understand that they're being charged better or worse than average. They can understand whether they're getting better or worse than performance. You can understand pretty easily with a Veralytic report or by working with a Veralytical advisor like Michael, whether or not your policy is fairly priced and whether the performance is reasonable. And contractually, if you're very, very pale and not breathing, the benefits pay. So it's that one's, contractually speaking, that one's pretty easy. On the long-term care side, having been in the insurance business a long time, I struggle with the combinations and permutations of benefits on long-term care versus chronic illness, activities of daily living versus reimbursement. I mean, it is. I think listeners really need to have help, a financial advisor in that area, even more so than just life insurance.
And I think that the one thing that I've learned from the fiduciary world is, and I mentioned this before briefly, if you don't understand it, find somebody who does. So if you're a life insurance person like me, and you're getting into these discussions that might be over your head, then you need to reach out to somebody like Bill. And that is part of the whole fiduciary responsibility or best interest, because there's no way that you can serve your client if you don't have the knowledge. And, that's one thing that people need to understand. I think it's happening more and more in the world today that people are specializing more and then creating informal alliances with people and referring business back and forth. And that's a very good thing, because a lot of this stuff begins, forget about the management. A lot of this stuff, it starts at the beginning. Does the client know what they bought? Do they think this is guaranteed and it's not? I can tell you that many times I talk on the phone with grantors and they all, well, the agent said blah, blah, blah. And, if the agent really said that, then that's a terrible thing. But the reality is, a lot of people don't remember what was said at the sales table. So, it's something that we have to be aware of if we're at the point of sale, to make sure that the client understands everything and maybe even put that down on paper. That's one. The other thing I learned from the Totally world is I always told trustees, when a policy comes in, put all the caveats, all the nuances about this policy down on paper, have that grantor sign it, because things get murky 20 years down the road when that policy should be paying off and it's not. And so for any of us who are out there in the marketplace, documentation is a key, and it covers us and it also helps the client.
Michael, to touch on what you were saying, clients need to know what they're buying. Mm-hmm. I will tell you, because it is my industry, my experience, I care about it, I dig into it. There are many agents who don't know what they're selling in this long-term care critical illness space. They don't understand it. And that's worse. Now, that's maybe not a fiduciary, but I'll tell you, I have worked with clients who their fiduciary money manager is only allowed by their broker dealer or their relationships to represent 2 companies for long-term care. And they're both a certain type of policy. And there's 4 other types of policies out there that advisor can't talk about. So again, I'm with you, because that's my business, is I partner as a specialist with folks who don't have the specialty. But you have to be able to look at the market. if you're doing investment management, you got to be able to look at the marketplace of investments. So anyway, that's my little niche here, Tony, that's, I think, growing as an issue related to this discussion we're having.
Fantastic. And it's a great discussion. I mean, this is so interesting, and we could go so many different ways with it. But, unfortunately, we have to wrap up the conversation. I think we could probably talk for hours on this. Is what are the number one tips for people for selecting and managing a life insurance policy and also a life insurance / long-term care insurance policy?
Barry,
I'll start and let the guys who are the experts on managing kind of pick up the detail there. I think the number one thing, if you're buying long-term care insurance or have an interest in having a benefit like that be part of your portfolio or part of your insurance, you have to work with someone who represents all of the different types, because otherwise you will not get a fair comparison. So it's making sure you're exposed to and being educated, from as much of a non-biased place as possible, what all of those options are. And then the managing of that is another step, but it picks up on many of the same things that we're touching on, and that's Michael and Barry's expertise.
Yeah, I would say three things. So first, I would echo Bill's comment that the long-term care side is complicated. I think it's beyond most consumers' natural ability to navigate by themselves, and really need an advisor. From a life insurance perspective, you got to understand three things. You have to understand what's being charged inside the policy, and is it fair? You got to understand what the performance that's required to meet your expectations, and is that reasonable? Are those performance expectations consistent with your risk profile? So costs, performance, and risk. Consumers have to understand that. They either can get those spreadsheet pages that Michael was talking about. If they're a do-it-yourselfer, you get those expense pages and you look at them and you compare those expense pages, or you work with a Veralytic advisor like Michael, or you get a Veralytic report, or insist that your financial advisor give you a Veralytic report. We used to give Morningstar reports as support for all of the investment recommendations we give. It costs the consumer nothing to say, hey, look, you say this is the best. There's this service out there called Veralytic. It's not a rounding error on the commission statement of some of the insurance agent. Can I get a Veralytic report just to make sure that what I'm getting is what I think I'm getting? So those are the cost, performance, and risk. However you get those three things. What's the cost, what's the performance, and what's the risk?
And Tony, I'm going to take it from a little bit different perspective. It's just working with a client and having them select a policy type. I like to break it down to here's the different types of characteristics in these different types of policies. Walk them through the different types of policies, and then focusing on the premium flexibility. Is it required or is it flexible? And talk about their investment risk. And that's kind of goes hand in hand with cash value. Do you need cash value or not? And then the last thing is the death benefit guarantee. Do you need a death benefit? Do you want a death benefit guarantee or not? And then I'll focus in on what Barry's talking about is the cost of that particular policy. Once we've gotten to a discussion of the type of policy that works for them. And then the last thing I'm going to throw in there about getting a life insurance policy, which is critical and is not talked about as much as it should, is the underwriting. Preparing today we have accelerated underwriting, which is fantastic if you're 24 years old and you're healthy as can be. Most of our clients are not. As a matter of fact, I read about these accelerated underwriting, and I'd like to get more of those clients because it's not been that easy to get people through underwriting. But, making sure the client understands the paramed, making sure the client, is ready for that paramed, and making sure that you have a good underwriter working for you and your client that can go through those health records and really paint the best picture for the client. Because as Barry knows, cost being equal, a standard non-smoker is going to pay more than a preferred non-smoker. And you want your clients to be preferred non-smokers. The agents have often will quote a preferred non-smoker rate because it's a little cheaper, but getting your client a preferred non-smoker rate is extremely important. So those are the ways that I would focus on it. But I do agree with Barry that the cost side, understanding the costs underlying the policy is hugely important.
Fantastic. Well, thank you for joining me today. I think the key takeaways obviously are asking questions, finding out more, taking a look at the actual expenses of the policy. Is there anything else to summarize the episode that you guys would like to add? Bill, anything you want to add to that?
No, I think, it's not just up front. And that's one of the things that you all have brought me back to in our discussion that led to this podcast today, looking at the policies every year critically. If there are moving parts, if there are non-guaranteed parts, you have to, as a client, as an advisor, stay and engaged with that over time. And I think that's just so important.
Fantastic.
Absolutely.
Any last words, Michael or Barry?
If you're a financial advisor, you can get a complimentary Veralytic report. Putting "get ready!" exclamation. You go just Google complimentary Veralytic report. The link to our website for complimentary Veralytic report will be at the top of the Google page, or just go to the www.veralytic.com and you'll see a link for complimentary Veralytic report, and just put in "get ready" as the promo code, and you can have a report on me to figure out how Veralytic might be able to help you with your clients. Do some of the things that we talked about here today.
Well, thank you so much. And I'll be sure to put that in show notes for our listeners, and along with links to Michael's website and book, Bill's website and podcast, to Barry, to your website. And thanks again for joining me today. This has been a fantastic discussion. It's been a pleasure.
Thanks a lot, Tony.
Always fun, Tony.
And thank you, everybody, for listening or watching to this episode. Until next time.